Gave you a stock tip, or you read something on the internet and you're considering buying a stock and you would like to research about it, what do you research? What do you actually check? So today I'm going to give you 3 quick stock tips that you can do quickly in 10 minutes to decide if it's a go or no go. It gives you a better perception. If you stay towards the end of this video, I'm going to show you one big tip of what not to do during your research, and this will help you in your investment journey. All right. So point number 1 is understand the business, or they do, how they make profit. So a company will be doing well if they do drive sales, net profit, and obviously good revenue. And some companies might not be selling, the sales might be declining, and that could explain why the stocks are declining. Do not just go in and go, oh wait, potential uprise, but check the sales and revenue. It might be the cause of the downward spiral in stocks. And do you want to put your money in that? Ask yourself that question. And number 2, is the company an international company that sells worldwide? Or maybe it's local within the country? Or maybe it's a one-trick pony. You have to think. Do not go greedy and go, oh, that company is going to go mega big. But if that business fails, the whole entire company. So think about it, all right? And the third point on understanding business is that growth and net profit are all being reinvested. So they're not making profit, but they're growing. So you're investing in the future value of the company. Dividend are stable companies rising in your portfolio because they're paying you the returning dividends. And also the third one is high risk. High risk meaning you're investing in a company for its future value. For example, in the UK, Cyrus Mineral. People are putting in money, but they're not expected to make money until 2023, 24, 25, I don't know. But people are pumping in money for this company, and just because some blogger out there say it's great, they're gonna make lots of money, but they're still not making money now. You're putting in money for future value. Is it worth the risk? Ask yourself that question. So now we're gonna go to point number 2. Point number 2, the technical finance. You don't need to be an expert to know about technical finance, but what I can explain to you is you need to watch out for, number 1, the debt. Is the company in great debt? Is the company borrowing money through bonds? If they're doing it, that means they're going through low cash flow and they want more money. So it's a bit of risk, okay? Margin. Not many people speak of margin on their blogs or recommendation or anywhere, but I respect margin quite, because if you open a company, if you sell something for $100 and you make $40 profit, which is 40% margin, that's really good. Do you know Amazon's margin's about 10%, Apple's about 15%, Facebook's about 40%. So think about it before you invest. Look at the margin cost, and you can find that in your Yahoo app or Financial Times. And the third one is investment. So is the company still investing a lot in the R&D? Because that's quite important. You can see sometimes the sales, high revenue, but low profit. But they're still growing. Why? Because they're reinvesting the money somewhere within the company to grow. So don't just look at a profit or loss. It looks at where the money goes to the cash flow. And also the PE ratio. So different industry will have different PE ratio. For example, car industries will have PE ratio below 10. For high growth company, the PE ratio for UK high growth companies should be over 30. But for American companies, high growth ratio PE can go up to almost 50, 60, 70, sometimes even 100, like Netflix and Amazon. So this is 4 key indicators you should watch out, that you don't need to be an expert. Try to understand, try to grasp it. It will help you in your research. And the final tip is the future of the company. You're investing in a company for long term. Okay, let's keep it simple. For example, tobacco company. If you look at tobacco company, technical financial analysis, it's a brilliant company. A good growing dividend, it's growing, P ratio is low, it's undervalued, blah, 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 blah. But is the future of tobacco company what you're looking for? In the next 10 years, will people still smoke? And millennials, when I say millennials, remember, in this global earth, the people who spend the most money are millennials. So, like for example, protein, meat. People are stopping junk food and sugary food. So all these companies that sell high sugar food are just not going to it, like Kellogg's. But then companies are selling more protein, more meat-based, because people are getting healthier. So most importantly, finally, is your own views. Once you put all these 3 quick tips together, you're going to put business understanding, technical finance, the future of the company, and then make it your own view. And then from there, you can make a judgment whether it's a buy or not buy. You stay towards the end of the video. I'm going to show you one thing that you shouldn't be doing when you're buying any stocks and shares. Do not just go and read someone else's blog, including mine, and make your judgment based on someone else's blog. If your own research matches with someone else's written article, that's a confidence booster. But you have to do your research first. Okay? So all the best. Market's getting exciting 2019 middle onwards. So hopefully these tips will help you. Have a good day. Bye-bye. And remember to sign up on YouTube, Facebook, Instagram. Follow me if you want these awesome tips in future. Have a good day.